Your credit score rewards you for borrowing and punishes you for saving. Credit cards shower you with points for spending, but offer nothing for keeping money in the bank. And if every American actually paid off their debts tomorrow, the entire banking system would collapse by next week. This isn't a flaw in the system. This is the system. Welcome back to Past to Profit, where history meets money. Here's what they taught you. Work hard, save money, avoid debt, and you'll build wealth. It's the American dream distilled into a financial strategy. Except there's a problem. The system doesn't actually want you to follow that advice. Look around. The entire modern economy is engineered to keep you borrowing. Mortgages that take 30 years to repay. Car loans that outlast the vehicle. Student debt that follows you to the grave. Credit cards designed so that the minimum payment never actually eliminates the balance. Even your credit score, the number that determines your financial life, doesn't measure how much money you have. It measures how reliably you stay in debt. Think about that. The metric that banks use to judge your trustworthiness isn't based on your savings, your income stability, or your net worth. It's based on your history of borrowing and repaying borrowed money. If you've never had debt, you have no score. If you pay off everything immediately, your score doesn't improve. But if you carry a balance, make steady payments, and borrow continuously across multiple accounts, perfect credit. The system isn't broken. It's working exactly as designed. Because banks don't make money when you save. They make money when you owe. And to understand why, we need to go back to the moment when debt stopped being something shameful and became the foundation of modern capitalism. For most of human history, banking was simple. You deposited gold, the bank kept it safe, and you could withdraw it whenever you wanted. Banks made money by charging storage fees, like a vault rental. Lending existed, but it was small-scale and often morally questionable. In medieval Europe, charging interest was called usury, and the Catholic Church banned it outright. But in 1609, something changed. The city of Amsterdam created the Wissel Bank, the Bank of Amsterdam, and with it invented a trick that would reshape the world. Fractional reserve banking. Here's how it worked. When merchants deposited gold, the bank didn't just store it. It issued them receipts, paper notes that could be traded as if they were gold itself. These notes were more convenient than hauling metal around, so people started using them for transactions. And here's the genius part. The bank realized that not everyone would withdraw their gold at the same time. So why keep all of it sitting in the vault? The bank started lending out the gold that people thought was safely stored. They kept a fraction in reserve, just enough to cover daily withdrawals, and loaned out the rest at interest. Suddenly, the same gold existed in two places at once, in the borrower's hands and on the depositor's receipt. The money supply had just doubled, not because more gold was mined, but because the bank created credit out of thin air. This was the birth of modern banking, and it came with a dangerous truth. Banks don't lend out deposits. They create new money every time they issue a loan. Your mortgage, your car loan, your credit card balance. None of that money existed before you signed the contract. It was conjured into being the moment the bank approved your application. By the 18th century, this system had spread across Europe. The Bank of England, founded in 1694, perfected it. They issued notes backed by government debt, meaning the money itself was debt. To hold British pounds was to hold a claim on future tax revenue. Money was no longer a store of value. It was a promise to pay. And the entire economy now rested on one assumption: that people would keep borrowing forever. Fast forward to the 20th century, and this logic went into overdrive. In 1913, the United States created the Federal Reserve, a central bank designed to stabilize the system. But really, to make sure it never stopped expanding, the Fed didn't just regulate banks, it backstopped them. It promised that if banks ran out of money, the government would create more. That guarantee removed the final restraint on lending. Banks could now loan aggressively, knowing they'd be rescued if things went wrong. And then came the final piece: credit cards. In 1950, a businessman named Frank McNamara went to dinner in New York and forgot his wallet. Embarrassed, he had to call his wife to bring money. That humiliation sparked an idea. What if there was a card that let you pay for things without carrying cash? He launched the Diners Club card. It wasn't a loan, it was a charge card. You had to pay the full balance every month, but it proved that people wanted the convenience of delayed payment. Within a few years, banks saw the opportunity and created something far more profitable: revolving credit. In 1958, Bank of America launched Bank AmeriCard, later renamed Visa, and introduced a revolutionary feature. You didn't have to pay off your balance. You could carry it forward month after month as long as you made a minimum payment. That minimum was deliberately set low, just enough to cover interest and a sliver of principal. At that rate, a balance could take decades to pay off. This was the masterstroke. Credit cards weren't designed to be paid off, they were designed to be carried. And the longer you carried a balance, the more interest the bank collected. A purchase that cost $100 could end up costing $300 after years of minimum payments. The customer thought they were buying convenience. The bank knew they were buying a permanent income stream. By the 1980s, credit cards were everywhere. Banks mailed pre-approved offers to millions of households. They targeted college students with no income. They raised credit limits automatically, encouraging people to spend more. And they hired psychologists to design statements that made the minimum payment look reasonable while hiding the true cost. The result? By 2024, Americans owed over $1 trillion in credit card debt. The average interest rate hovered near 20%, higher than almost any other form of borrowing. And the system depended on a specific type of customer, not someone who paid in full and not someone who defaulted, but someone who revolved. Someone who carried a balance month after month, paying interest forever, without ever escaping. Banks even had a name for people who paid off their balances every month: deadbeats. Because those customers cost the bank money. They used the service but generated no profit. The real profit came from the revolvers, the people trapped in the cycle. But credit cards were just the surface. The entire financial system had reorganized itself around the same principle. By the late 20th century, debt wasn't just a product banks sold. It was the architecture of the economy itself. Mortgages became 30-year obligations, stretching across entire careers. Student loans ballooned into six-figure burdens that couldn't be discharged even in bankruptcy. Car loans extended to 7 years, longer than most cars lasted. And businesses stopped financing growth through profits. They issued bonds and took loans, leveraging themselves to the hilt. This wasn't accidental. It was policy. After the 2008 financial crisis, when the global economy nearly collapsed, governments didn't crack down on debt. They encouraged it. Central banks slashed interest rates to zero, making borrowing cheaper than ever. They wanted people to take loans, buy houses, spend money, anything to keep the machine running. Because here's the secret. Modern economies don't grow through production anymore. They grow through credit expansion. Every time a bank issues a loan, new money enters circulation. That money gets spent, creating demand, which signals businesses to produce more, which creates jobs and income. It's a cycle. And it only works if people keep borrowing. If everyone stopped taking loans, the money supply would shrink. Demand would collapse, businesses would close, unemployment would spike. Deflation would set in. And deflation in a debt-based system is catastrophic. Because when prices fall, the real value of debt increases. A mortgage that felt manageable suddenly becomes crushing. Defaults rise, banks fail, the system unravels. That's why banks need you in debt, not because they're evil, but because the entire structure of modern capitalism depends on it. Your mortgage isn't just your burden, it's the collateral for someone else's retirement fund. Your credit card balance isn't just your obligation, it's an asset on a bank's balance sheet, used to secure more loans. Your student debt isn't just your problem. It's been packaged, sliced up, and sold to investors worldwide. You're not just a borrower, you're a product, and the system is designed to keep you producing forever. Now, here's where it gets darker. The system doesn't force you into debt. It simply makes every other option harder. Want to buy a house? You'll need a mortgage. And to get one, you'll need a good credit score. Want a good credit score? You'll need a history of managing debt. Want to build wealth? The stock market rewards companies that borrow aggressively to buy back shares and pay dividends. Want to save? Interest rates on savings accounts are near zero, often below inflation, meaning your money loses value just sitting there. Every path that doesn't involve debt has been made unattractive. Saving is punished through low returns and inflation. Paying cash is inconvenient and sometimes penalized. Even businesses that try to operate debt-free are seen as inefficient, undervalued by markets that worship leverage. The illusion is that you're making free choices. In reality, the game has been rigged to funnel you toward one outcome. Borrow, spend, repay, borrow again. And if you break the cycle, if you pay off everything and refuse to take on new debt, you become invisible to the system. No credit score, no access to mortgages or loans. Financially free, but economically exiled. That's the trap. Freedom from debt means freedom from the system, and the system can't allow too many people to be free. So who benefits? Not you. You're paying interest on money that didn't exist until you borrowed it. Not the economy, which is now more fragile than ever, dependent on endless credit expansion to avoid collapse. The beneficiaries are the institutions that sit at the center of the debt machine, the banks that create money through loans, the investors who buy repackaged debt as assets, and the governments that rely on credit growth to keep GDP rising and voters calm. This is the hidden architecture of modern capitalism.
It's not a system built on production, innovation, or savings. It's built on leverage, on the belief that tomorrow's growth will cover today's borrowing, on the faith that the cycle will never stop. But history teaches a brutal lesson. It always stops. Rome debased its currency to fund its empire, and the economy collapsed. Weimar Germany printed money to pay war debts, and hyperinflation destroyed the middle class. The 2008 crisis proved that even the most sophisticated financial systems can seize up when debt becomes unsustainable. And yet, here we are again. Global debt now exceeds $300 trillion, nearly 4 times the size of the global economy. Governments owe more than they can ever repay. Corporations are leveraged beyond reason. Households are stretched to the breaking point. And the solution every single time is the same: borrow more. Because the system doesn't have an exit. It only has a delay. And every delay makes the eventual reckoning bigger. The uncomfortable truth is this: banks don't want you in debt because they're greedy. They want you in debt because the system requires it. Your mortgage funds someone's pension. Your credit card balance backs a corporate bond. Your student loan has been securitized and sold a dozen times over. You're not a customer. You're infrastructure. And the only way to escape is to see the game for what it is. Not a moral failure on your part, not bad luck, but a system designed from the very beginning to turn your future income into someone else's present profit. Debt isn't the bug, it's the feature. And once you understand that, you stop blaming yourself and start questioning the machine. If this gave you a new perspective, hit subscribe. History has the answers. And on Past to Profit, we'll show you where to look.